The world looks a little different than it did a month ago. Oil prices have surged past $100 a barrel. The RBA has raised interest rates again, and business owners across the country are asking the same question. What does that mean for me? In this month's update, I'm going to cut through the noise, share what's actually selling in New South Wales commercial property right now. Real prices, real yields, real signals, and tell you what I think it means if you're planning to exit your business or property next 3 to 10 years. Let's get into it. Before I get into the sales data, a quick read on the environment, because context matters. The RBA raised the cash rate again on 17th of March to 4.1%. That's a second consecutive increase this year. And it was a close call, 5 votes to 4. Governor Bullock was direct. Inflation picked up, and the confidence and the conflict in the Middle East is making it worse. Annual inflation is currently running at 3.7%, both well above the RBA's 2 to 3% target, and those figures don't yet capture the full effect of the oil spike and the continual situation with Leased. Meanwhile, unemployment ticked up to 4.3%. But before you read too much into that, employment actually grew by 43,000 in February, and the participation rate was at 66.9%. The labour market is still relatively tight. Here's my honest read. This is a cautious market, not a broken one. Caution always shows up in commercial property, in longer diligence periods, tighter lending, and buyers looking harder at income certainty before they commit. That's exactly what the sales data this month confirms. People are doing their homework more. It's consistent. But people are still inquiring. People want to buy. They're very conservative what they're buying. They're very careful. So they need to have all the right information to have the confidence to go ahead and purchase. Each month I track actual sales across New South Wales, not estimates, not asking prices, what buyers actually paid. Let me walk through April's data, or the most recent data. First, I'll go into retail. There's a place sold in Crow's Nest recently in Willoughby Road, sold for $3.875 million. 163 square metre building with high foot traffic. Village, strip. Net income of $150,000 per annum. Now, what does that mean? What does it tell us? Buyers are still paying premiums for well-located convenience retail in established neighbourhoods, walkable neighbourhoods. Position still drives results, even in the uncertain environment. Let's move on to Silverwater. Property in Moore Street sold for $3.21 million, vacant possession, 401 square metres of building area on a 580 square metre corner site. That works at just about around $3,500 per square metre for the building area. What are the signals for us? Owner-occupier industrial in quality middle ring location is holding its value strongly. If you own your business premises and have been wondering whether to sell the property separately, numbers like these are worth understanding. Leased retail, this is in Lake Macquarie, Toronto Lake Macquarie in James Street, sold for $1.625 million. Leased a Pizza Hut, net income $78,839 per annum, equating to a net yield of 4.86%. Sub 5% for a single tenant retail asset in a regional location. That tells you how hard buyers are working to find reliable income-producing property. Tenant covenant matters. Lease certainty matters. Both were present here, and buyers paid accordingly. Let's move on to Childcare Centre in Port Macquarie recently in Hindman Street. A 24-place childcare centre sold for $1.551 million. Net income, $80,593 per annum. That represents a net yield of 5.15%. Childcare continues to attract capital from non-discretionary essential service assets. Sub 5.5% for smaller regional centre reflects the structural demand from investors who value income security. If you own childcare linked property, your lease compliance and leasing records directly affect how buyers value your asset. Now, this sort of property would have been lucky to sell for about 7% 10 years ago. That's how far the market's gone, how the attractiveness has increased with childcare centres. Multi-tenanted retail. This is on the Milton, the south coast. 10 commercial shops sold in one line for $2.24 million. Net income $156,647 per annum. A yield of approximately 6.94%. Nearly 7% compared to under 5% in Crow's Nest. That yield gap is risk being priced. Regional locations, multiple tenancies, reletting exposure, buyers factor all that in. If you own something similar, documenting occupancy history and tenant stability can help close the gap between what buyers fear and what the asset actually delivers. Crescent Head, New South Wales. This is a 12-bedroom, 9-bathroom lifestyle property on 137.5 hectares, catering for up to 29 guests, sold for $5.58 million. This one sits at the intersection of tourism, agriculture, and lifestyle. And the story, what it offers beyond the numbers, is often as important as yield. When you're selling a property like this, what this data tells us, looking at those 6 sales together, few things stand out. First, the market is not one market. Village retail in a strong city location is trading on completely different terms to regional, multi-tenanted strips. Industrial with good fundamentals is still one of the best performing sectors. Lifestyle and boutique accommodation is attracting a growing buyer pool. Second, buyers right now are focused above all else on income certainty. Long leases, reliable tenants, clear documentation. The more proven the income story, the more attractive the asset. That pattern runs through every sale this month. Third, this is something I've been watching for a while. Perhaps 5 to 10% of the active buyer pool is genuinely well capitalised and able to move quickly on the right investment. The rest are struggling with finance conditions, deposit requirements, and lender scrutiny. When a quality buyer does turn up, you want your property to be the obvious choice. So here are the 3 questions I'd be asking if I owned a commercial property right now. Where does my asset sit on the spectrum? Am I presenting it in a way that reflects how today's buyers think about risk and income? If I sold it in 3 to 5 years or 7 years, would a buyer see something well prepared or something that needs work before they commit? Industrial property. Sydney's vacancy rate sits at 5.8%, but new supply across the eastern seaboard fell by around 20% last year and is forecast to drop a further amount in 2026. The construction cycle is winding down. Existing owners of well-located property are in a strong position, but prime versus secondary is diverging sharply. I cover what this means practically and what actions are worth taking now. Lease structures. This one I see cause problems at the worst possible time. When the sale is already underway, a poor structured lease, informal arrangements, unclear rent reviews, expired options can slow a deal down, get it renegotiated, or kill it entirely. A well-structured lease, on the other hand, can make an average property punch above its weight. I'll walk through the specific things buyers and their advisors look for and what you can do if you're 3 to 10 years from selling. Both articles on the newsletter, free subscription, linked below. The theme this month is fairly straightforward. Uncertainty is not a reason to wait. I've never seen a period in 4 decades where everything was settled. So the situation is not really unusual. The owners who do best are the ones who use these moments like these. When the market is cautious, when the rates are rising, when the headlines are noisy, to get their affairs in order. If you find this useful, subscribe to the channel. I put out a marketing update like this every month, plus a deeper content on commercial property and business transition and exit planning. You can subscribe to the Transition Edge newsletter in the description below. It goes out monthly and covers all of this in more detail. And if you've got a specific question about your property or business, I'm always happy to have a conversation. Details below. Appreciate your comments. Subscribe to this channel. Until next month.